Ching ching ching! Let me hear them dollar ring. Hello and namaste and welcome to MOM Square, Money on My Mind. I am Vivek Shetty, an engineer by profession and an investor by addiction. If you and I share the same addiction, we are on the right page. Yes, we are on the right YouTube page. And while you're there, do not forget to hit the subscribe button and the bell icon. Okay? So guys, yesterday we talked about the market crash that I'm expecting. Okay, again, did not mean to create any panic of any sort with the viewers, but I am expecting a market crash. And today we are going to touch base on and talk about what I am going to do to protect my hard-earned money against this crash. Okay, I would rather lose my opportunity to gain in situations like this than lose what I have earned, right? Always put it in that perspective, okay? It's not a gambling, it's investing, okay? So you have to know when to change your strategies from being a little risky to being a little risk averse, okay? So plan accordingly. Again, I'm not an investment advisor, so anything that I'm sharing here is purely for entertainment purpose and just for sharing my insights and my experience with you guys. You guys should do your own research and use your subjective decision making to change your strategies or work on your strategies. But again, this is to help us all talk about it and share our opinions and hopefully add value in the process. Okay. Yesterday, if you guys remember, we talked about intrinsic value of stocks and then emotional value of stocks. I'm gonna expand a little bit more on the intrinsic value of stock before I jump into my strategies, so you can relate to what I actually mean with my strategies. Okay, so first of all, intrinsic value of stock, as I mentioned yesterday, is the real value, the book value of a stock, if you want to say that. Okay, and there are a couple different ways to calculate that. There is a discounted cash flow method. There is analysis based on financial metrics. Then there's asset-based valuation. Okay, so long story short, you're trying to create a valuation for a company, XYZ company, and depending on the number of outstanding shares, you understand what the stock price should be based on intrinsic value. Okay, maybe I'll do a quick rundown on what each of them is. Asset-based valuation is, as the name suggests, it's based on the net asset minus liabilities. That's what the valuation is. It's not a preferred method really by a lot of analysts because it doesn't account for the future growth prospect for that company. Okay, the other two methods do account for that. There is one based on financial metrics, wherein they're gonna look at they will be using PE ratio, price to earning ratio. Think about an XYZ company that has I'm going to look at my example here. XYZ company that generated an earnings of $3.30 a share over the last 12 months. Let's assume that they will be growing at roughly 12.5% over the next 5 years. Okay. Then you assume that the stock currently has a PE ratio of 35.5. Okay. So the intrinsic value would be the $3.3 times the 12.5% times the 35.5, right? So in this example, I wrote it down because obviously I can't do the math that quickly. The stock price, based on intrinsic value, would have been $131.79. Okay, you can write this formula down, or you can Google it. I learned it in my finance class, but it's one way to do the valuation based of a company based on intrinsic value. Okay, the third method, which is preferred by a lot of analysts, is the discounted cash flow analysis. Here, what they do is they look at the cash flow for current year. They have forecasted cash flow, right? What is the sales going to be for next year? What is the revenue going to be for the following years, and so forth? Then you discount it backwards. Discounting is nothing but adjusting for net present value. Okay, think about it as you are what is $10 from 2025 worth today? So you're discounting, right, based on what there's an interest rate assumption you make. Again, I'm not going to get into the two specifics, but you make an interest rate assumption that, okay, I can make 10% investing my money somewhere else. So you discount accordingly and so forth. Okay. So The third method is what's most commonly used. Now, you can choose any method, okay, or you can rely on analyst data for finding out intrinsic value. But where I'm going with this is it's important to understand how to value a stock based on intrinsic value. So let's talk about my strategies, right? You get, let's put that on the side. It's more of theory that I threw out there, but it's important so we understand what is intrinsic value, so you can do the math and calculate, the companies you research on or you're interested on. Okay, let's talk about what are my strategies going to be. My strategy does not include run with my money for sure. Okay, I'm not exiting all my stocks. I'm not going to pull out all my cash in the stock market or the real estate market. That's not happening. Okay, that is one bad practice in general. Yes, you could get lucky and potentially time the market. There's no good way to time a market. So all you can do is expect a dip coming and then shuffle. Okay, so I'm going to be shuffling my funds, not pulling it out. Okay, when I say shuffle, what I'm going to do is going to be moving my stocks from more like speculative stocks, or call it meme stock or highly valuated companies, right? I'm going to pull my stocks out of those kind of stocks and start investing into more intrinsic value based stocks or stocks that are undervalued. So what's undervalued is when stocks are trading under the intrinsic value of a given company or a ticker symbol. That is what would be deemed as undervalued. So you could look up in general. I'm sure if you go on Google, if you look for what are the most undervalued stocks, I'm sure there's a list that will be thrown out there. But I would suggest pick the company. So it's a hybrid approach. Okay, first I'm going to be shuffling money. For shuffling, I'm going to be pulling it out from the risky, overpriced stocks, the meme stocks. I don't have meme stocks, but I'm saying if you do have one, you can pull out of that and start investing into undervalued stocks or intrinsic value-based stocks. Okay. Then while you're doing this, also account for stocks. So you'll notice that there will be some stocks, let's say Tesla, for example, that is not going to pass this criteria for intrinsic value. I'm not going to suggest you pull out of it because of that. Okay. No, you should understand if, let's say Tesla scenario, you like the company because you believe in their future prospect. Obviously, future revenue is accounted for in your intrinsic value calculations. However, you believe that there's more to it. There's more surprises that could be coming from Elon, and then you want to protect yourself from losing out on that opportunity. I totally get it. Stick on those stocks, in my opinion. Ride the dips. And in fact, if you see a dip on any of your favorite stocks or not emotional based, okay, favorite stocks because you trust the product, you trust the management. That's what I mean by favorite stocks. Okay, for me, my favorite stocks is CCIV. I'm pretty high on that. PSTH, right, for various reasons. So basically, identify the stocks you love, not because you're emotionally attached to it, but because you believe in the product or service they provide or the management that stands behind it. Okay, so you identify that stocks, and you can let go of that rule number one of shuffling based on intrinsic value if you see that there is more potential. But when that happens, and if the market actually drags it down, because anytime a market dips, it acts like a boat anchor and pulls everything with it, right? S&P falls, Dow Jones falls, automatically, again, the emotional aspect is going to be triggered, and some people will sell it, right? So what's going to happen with that is, let's say in your case, Tesla, just an example here, is dropped another 30-40%. My rule of thumb has been anytime you see a correction as high of 30 or 40, like 30, 40, 50, start buying, right? And if you bought it at $700 and then you see a 30% dip, add some 50% from that $700 or $800 price, add more. So add it in layers, but enter during the dip on the 30% milestone maybe. Okay, some people can wait longer, 40, 50. It also depends on how much equity you have in hand. Okay, so those are some of the things I plan on doing. Okay, I also plan on doing a very a lot of us forget to do this. Okay, before I jump into that particular topic, I'll come back to it. But also make sure that you're putting money aside in savings, okay, to protect yourself from any unknowns. Okay, during this, when this dip happens, a lot of people are challenged at jobs, and we could lose our jobs and whatnot. So start improving your saving net, but take 50% of the saving net and set it aside for stock market, because that's gonna act as buy the dip opportunity kind of thing for you, because it gives us a boost when the economy is picking up. Okay, so be ready. Like, for example, if I have a portfolio of $100,000, okay, and I'm currently invested $50,000 already, I'm going to shuffle that, and then there's 50,000 in some meme stocks, risky stocks. I could either shuffle them or sit on some of it. Okay, I do plan on sitting at, let's say, 30%, 40% cash. Okay, I want to sit on that amount of cash, and I'll continue to keep adding towards that cash pile, because that's the best thing to do when there is a dip or when there is a major correction coming. Build on that cash, and then don't wait for too long. Okay, thinking that the dip's gonna keep going. I've done that mistake last year too. Where I thought the Dow Jones was gonna go all the way down to like 18 or 16, I forget. Yeah, I was hopeful, not hopeful. I was actually thinking I'm gonna time it. I shouldn't have. You set a target. If you think the market's gonna go in the correction mode and hit 24, for instance, okay, start investing when it's at 26, and slowly, like, maybe enter 50% of your cash pile at that 26,000 Dow Jones, and then start to slowly keep adding at every opportunity you find. Okay, so that's one thing I want to talk about. And the last or second last thing that I want to talk about is, a lot of people forget about their 401ks. Guys, that's a lot of money, that hard-earned money that you have worked on, or piling up over years. Do not just let it sit there. A lot of people have this mindset that, oh, you have to, you shouldn't just, you should just leave the 401k alone. It will ride all the dips and highs and whatnot, and eventually you will come out positive. I get it. But when you expect a major dip like current state, you should be evaluating the strategy. In my case, I plan on moving that into a less risky options. Okay, and in fact, in my case, I'm going with more like not bond necessarily. It's a fund where they have a heavy weightage on actually it is some of bond and so forth. It's the lowest risk option I had. I can talk about the structure if you want me to in the comment section, but that's what I'm doing with my 401k, because it's a decent chunk of money that I've saved for my retirement, and I think I can quickly increase that return on it if I time it, or try to time it at least, right? The last and very important, I think we talk a lot about investment in general. The last thing I want to talk about is you can invest in stocks, you can invest in real estate, you can invest it whatever the heck it is that you want to invest in, okay? But do not forget to invest time into your family. Okay, I know I'm sounding in the preaching mode right now, but take some time, especially when the market corrections are happening. There's a lot of stress happening at work and whatnot. Make sure you invest into your family. Give them the time. Your son, your kids, your wife, your girlfriend, whatever it is, your parents. Give them the time. So invest time there as well. Okay, or that's an investment strategy as well, I guess. Okay, hopefully, guys, that video was helpful. It gives you an insight of what I'm planning on doing to, basically deal with this market decline that I'm expecting. If that helps you, if you liked the video, please do not forget to hit subscribe. It means a lot to me, and I appreciate for the guys who have already subscribed. I'm happy to see that I've gained 70 some subscribers in the last 5 or 6 days. I did not expect it to be that, really. I mean, I entered into this just hoping for the best, giving my best, right? Please do hit subscribe. I do have a goal to hit 500 subscribers soon, within a month. And if we do, I guess, even if it takes longer, once we hit the 500 subscribers, I will be doing giveaway. and I will talk about the giveaway in a little bit, in the next videos or so as we get closer to the 500 subscriber mark. Okay, subscribe, like, hit the bell icon. Adios.